Going through the motions is not what anybody truly ever hires you to do. If you just do, and again, the basic idea, do a little more and sometimes a lot more than is expected of you, and people tend to value that. The money is here to serve you, your goals, your desires, that you've saved it for a reason, and the reason is to accomplish the things you want to do. You really want to do it now when it has value to you, because something deferred from 65 to 85 will not be the same experience, not even close. If everybody tends to be sort of panicked about something, that's probably a time where you want to ask yourself, should I be panicked? Do I think in my portfolio I'm taking too much risk? If you are, then it should be addressed. But if you're not, you probably don't want to make major changes at that point in time.
Welcome back to the Personal Finance Project. We have a special episode today because Scott and I are joined by Richard Ashcroft. Richard is a certified financial planner, a certified private wealth advisor, a retirement management advisor, and has his master's degree in personal financial planning. And he is a managing director at our group here at Baird. He has been recognized by Barron's, Forbes, and the Financial Times going back more than a quarter century for the work that he's done in the industry. He's also the leader of our financial planning practice here at Baird in the Ashcroft Pesic Bartosh group. And we have continually ranked in the top 20 teams here since joining Baird. And in that time, Richard has also continually ranked as a top 10 advisor at the firm. So, Richard, welcome to the Personal Finance Project.
Thank you, Greg.
We thought today, we've come up kind of with a list of questions, Scott, Hannah, and I, that we thought might be fun to just kind of pick your brain on for the better part of an hour. We hope so. We've stricken some of these questions, and obviously you can take the questions any direction that you want. But some of them are going to be cliche, but I think sometimes you can get some wonderful responses from those questions. So I think we just dive right in. And the first question we came up with was, what was your first job and what did you learn from it?
My first job was when I was 14. I worked at a little family-owned grocery store out in a citrus growing area in the East Valley of Phoenix. And what I learned from it was do a little bit more than you're expected to do, and you will quickly rise to the top of the list of employees. It was interesting to observe the family-owned portion of it. You had family members working in the store and employees, and they conducted themselves very differently. Ownership conveys, I think, a different approach to your work than just simply being an employee. And that's really something that stuck with me my whole career. One of the things that attracted us to Baird was that this is an employee-owned firm. So we're not just employees, we are owners. And I think you get the best performance out of people when that's true.
Yeah, and another one on that same vein I've seen is, you pour grease or you pour oil down a sink of a rented house as opposed to you let it dry and throw it away if you own the house and the plumbing system.
Yeah, and I think the renter's mentality is very different from the owner's mentality in various aspects of life. And we saw this when Cam and I were looking to buy a house. There was one that had been rented and it showed.
Yeah.
And so I feel like if you are a renter mentality in your work product, it's going to show and it's going to be pretty obvious.
Yeah. Going through the motions is not what anybody truly ever hires you to do. I mean, I think a lot of people hope they can get away with that. But if you just do, and again, the basic idea, do a little more and sometimes a lot more than is expected of you, and people tend to value that dramatically.
So, Richard, turning to the work that we do here, if you were to give, one piece of advice to the clients that we work with as maybe the core tenet of our philosophy or the strategy that we use in managing accounts here, what would you kind of distill that down to?
I think it might be something different than people would expect, but for me, it would be to keep in mind that the money is here to serve you, your goals, your desires, that you've saved it for a reason, and the reason is to accomplish the things you want to do. I think it's easy to turn your focus on the money itself, having more of it, accumulating more of it, without thinking of it as a means to do the things you want to do in life. And one of the things that's very critical to our work is making sure that clients are able to use their money with comfort. So if they get ready to spend some money, whether it's traveling or educating their grandchildren or whatever the case may be, can they do that without feeling that they're jeopardizing their ability to remain retired, for the rest of their life?
Mm-hmm.
So if there is a principle, it is, and you can observe this with a lot of our clients, the people who have had that sense of priority, that this money is here to do the things in life that I value. They, in my observation over 4 decades, lead much more enriched lives than those who are absolutely focused on the money. And there's always kind of sad epiphany for a lot of those folks as they get very far along in life and realize, I'm going to leave people vastly more than I ever spent on myself. And in some cases, and they're not even people I care about. So,
Yeah.
Scott and I were just talking this morning about the now, I think, questionable Stanford experiment with the marshmallow test, where you give a kid a marshmallow and you say the experimenter is going to come back in 15 minutes, at which time they will hand you a second marshmallow, and at which time you can enjoy both if you so choose. And Scott and I were talking about how many of our clients who have an engineering background or a law background, they are very good at deferred gratification, where they were the kids who were probably going to pass the marshmallow experiment. Now, the subject of whether or not that was a valid test of people's ability to delay gratification, I think, is valid. But it also occurred to us that at some point, you got to start eating the marshmallows.
Well, anybody who grew up in a house with me realize I've never been a believer in the marshmallow experiment. There are a lot of assumptions packed into it that I think are highly questionable. First of all, why should this child trust this experimenter? He has on a white coat, so he's a trustworthy individual. I think it depends on the context of the child's life. If the child says, look, I'm very used to being disappointed. I'm very used to hearing promises that are never fulfilled. That child would be rational to eat that marshmallow as fast as it possibly could. I think, by the way, that's one of the social science experiments that has not replicated very well. And I think if you just thought about it a little bit, you can see why it wouldn't replicate very well, because the assumptions are so questionable to begin with. But I think the deferred gratification part of that, to say, is there a time? And it's true, we do work with engineers, scientists, and so on. Diligence, and I think having a plan, sticking to the plan, being very willing to do what you need to do during difficult times to adhere to your goals. Those are great skills to have in life, without a doubt. But at some point in time, you also have to take a look at what is the point of what I'm doing. There are lots of people who have diligently worked careers at objectives that we might disagree with fundamentally. But I think if your objectives are the things that you truly value in life, and you apply the diligence and discipline to them, then that's a wonderful thing.
Yeah, and I think that you pretty much just touched on it. A question that I kind of bluntly ask at times as we get maybe a little bit later in a retirement timeline is, what are we trying to do here? And if we're trying to grow this money to leave a big estate or endowment or something like that to a university, then let's make sure we understand that's the goal. But if it's to cover your needs, a lot of times we've solved for X, so to speak, and taking that additional risk or pushing the envelope, who is it serving? Probably not you.
Yeah, and I think it's easy to lose track of that. I mean, when you're goal-oriented in life, and most of our clients are, or they wouldn't have achieved what they have, the money is a bit of a scoreboard, and they're looking at the scoreboard. And the larger the numbers are, the better that it feels. But as you guys know, one of the things I always talk about is, what does winning look like? How do you know when you've accomplished everything you need to do, and now you no longer are working for the money, but the money is working for you? And a lot of people aren't particularly good at making that transition to say, well, this money is here to serve me, not the other way around, because you have clients who will actually defer doing things they want to do in order to accumulate a little bit more money to be used when. One of the things we try to spend time with people to just come to an understanding of, because we've transitioned through retirement to death with lots of clients, is to realize that there's a point in your life, for all of us, when the things that you might want to do when you are relatively young, in your 60s, you won't either be able or want to do when you're in your 80s. So that there is a point beyond which deferred gratification has no point,
right?
Because your deferral time is over. So I think a counterintuitive discussion we have with lots of clients really amounts to do it now. If we've done our work properly, and if what you're talking about spending the money on isn't excessive or foolish, and with our client population, it never is, you really want to do it now when it has value to you, because something deferred from 65 to 85 will not be the same experience, not even close.
And
Go ahead.
just as one final thought on that, it's pretty easy to get new high scores at the arcade when you keep feeding quarters into the machine. And so
Yeah.
in our work, what we typically do is start working with you when you've stopped, you don't have any more quarters to add to the retirement nest egg, so to speak. So I think there is a psychological aspect of, okay, am I going to be able to keep growing this if I actually am not contributing to it and I need it to actually give me some money, send me back some quarters, so to speak.
Yeah.
Exactly. Which is the reason you saved it in the first place.
Yeah.
What was the whole reason you were playing?
Yeah.
I think that actually segues nicely into, this is a question popularized by Peter Thiel, which is, what's something that you believe that most people would disagree with?
If I were to pick the number one, and I believe this for a very long time, it's that work is inherently valuable. I think there's a notion in our culture that work in and of itself is valuable. And I think that's a viewpoint that makes sense to enhance and to support in some ways. But the truth is that it isn't absolutely true that just working is valuable. When I manage people, I could observe in the office very hard workers that accomplished virtually nothing, but they were comforted by the fact they were working very hard at accomplishing nothing. So the work has to have a purpose. It has to have a definition of what it is you're trying to achieve. It has to have a goal. If you're just putting in effort toward no specific goal or the wrong goal, I first observed this when I was a construction worker in college. The same amount of work to do it wrong and do it right doesn't have the same value. And you would often see in construction that a small mistake had been made in the layout, for instance. Work's done, and then you realize this all has to be torn out. So not only did the work not have any value, it was counterproductive.
Yeah, I think some people can fall victim to, and I'm not exactly sure if this is a real term, but a Sisyphean fallacy.
Right.
Where just pushing the rock for pushing the rock's sake, even if it's going to roll back exactly to where it was at the end of the day, was for whatever reason valuable. And I think that you can often see, busyness, or I think you used to call it a slightly more charitable phrase, is just chair time. You are perfectly happy to have spent 8 hours in your chair, even though, like Sisyphus, if you have not moved your business forward in that 8 hours, why are you feeling comforted by that work? I suppose because there's a lot out there now with talks of the rise of AI, or what will it mean to be a human being in a world where many of the more, I would say, not menial, but more of the more grunt tasks are being accomplished by agents. What will that mean? Will that mean that we have a life where we can spend our time, reading poetry or languishing in hot tubs eating cake? Because I think that the phrase back then, I don't know who said it was, even if we were to reach that stage, people would tear it down just to have something to do.
Yeah. Yeah, I just think in general, though I am a supporter of work, and I think that if you want to achieve anything, you are going to at some point have to work. But the work itself, unless it is achieving a preconceived goal that is valuable, is of no value whatsoever. In fact, we could point to a lot of areas maybe in the world and history where we would have preferred that folks not work.
Yeah.
Whatever it was
Take
they
a
were
break.
doing. Yeah. Stop. I mean, so if there's one thing that might be my number one.
All right.
So building on that, we kind of know that work is not inherently valuable, or at least that's a thought that you have. How do you prioritize as you start your day? What are the things that actually have value to you versus are kind of the busy work or the low hanging fruit that's not worth picking?
Sort of like categorizing things in the Eisenhower's matrix, the urgent and the important. How do you prioritize in our business when it feels as though everything now is in that urgent and important, or more likely like our email inbox, urgent but not important?
I think this goes beyond your day-to-day work life. I think it applies to your life in general. I remember once a young person came to me for marriage counseling. Questionable decision on his part. Came and said, I've got some real problems here that I wanted to talk through concerning my marriage, and the perspective that I would have on that and anything with regard to your professional life as well is, do I think this issue will be important in 5 years? If it will be important in 5 years, 20 years, it is a priority because it's going to be an enduring priority. If it's just it needs attention right now, then I think you might want to make that a second level or third level priority. And I think people often get caught up, and it's often easy to do the thing that presents itself the most dramatically to you. Someone's on the phone, etc. Without saying, yes, but is there someone that I should call? Because I know that there's an issue here that needs to be addressed, that maybe they're far along in their life and there are some decisions they need to make. There was a case I had not long ago. Wonderful couple who I'd worked with for years. He was near the end of his life, wasn't particularly convenient, but it became a number one priority to drive out, visit with his wife, soon to be widow, and talk about some things we needed to do before the end of his life that proved to be important things to do. Mm-hmm. So I think that, and they will remain so for a number of years. So I think that's a standard that if you just observe that, now it's often hard to determine what really will be important in 5 years. But one thing always, I think, rises to the top of the list, which is people, relationships. Those are going to be critical for a long period of time. Just addressing something that's maybe topical in the news, probably not.
Yeah, and I think, and this has certainly been true in the time that I've spent at Baird, is often there can be a bit of a discrepancy between what we view as the things in a client situation that are really going to move the needle in terms of the financial success that they're going to have over the course of their retirement. You've touched on a couple of those things. But those are not always the same as to what clients regard as the more important elements of their plan. And I think this is where that divide can cause some issues, because one of the things as a team we try to have an absolute zero tolerance policy for is money has got to go in the appropriate amount from where it is now to where it needs to be, because that 1 day delay can be a real sticking point for a client relationship, but other things can too. Baird Online not working appropriately or what have you. So I guess, how do you navigate that where sometimes clients can get hung up on the minutia, like, a couple of basis points expense versus what they're taking some risks that they're not even addressing over here, but that you've been constantly telling, hey, let's ignore some of these other small things and address this problem.
Well, I think your role is to help people make better quality decisions. I think at times clients aren't clear in their mind about that key issue in the relationship. They feel like you're giving them various ideas, advice, without realizing that advice is shaping their decision. We really can't make any decisions on our clients' behalf exclusively for them without their involvement. So ultimately, it's a process of helping them get a framework. We are professionals in a particular domain. Get a framework for making a better quality decision. Often there is a very compelling story out there in the world that something needs to be addressed immediately. I read it this morning in the Wall Street Journal. And if you think about that over the course of a long career, you will realize that a strong dollar's bad, a weak dollar's bad. That the Japanese are taking over the world, and now it's the Chinese. And these things recur with predictable regularity. To help clients sort through and determine of these things what is truly important to you, your goals, your ability to live in retirement the way you want to, that is a big part of our role, is to help them put these things in a context that allows them to make better quality decisions.
Yeah, I think one of the discussions we just had off air a little bit ago was it's really important. There's kind of two ways we've heard people discuss Donald Trump. And one of my favorites is he's a man that you need to take seriously, but not literally. And then there's another, which is with Donald Trump, you really need to pay attention to the signal despite all the noise. But I think, unfortunately, in many respects, and this isn't necessarily to undercut him, he's a bit of an air horn of noise. And so we've got a lot of that right now with tariff uncertainty. You know, Scott and I were joking that Liberation Day liberated the market of about $6 trillion of value and where that might pick back up in July. So I think one of the phrases that we hear over and over and over again, and people in many publications have their opinion on it, it is different this time.
You do hear that. I'm reminded of a Peter Lynch quote that goes back to the 1980s when he was running the Fidelity Magellan Fund. Just said that they, at the time, had, and it may very well still be the case today, one of the most impressive track records of performance ever accrued in the fund industry. And he said that he loved to go visit a company and be told that the business was so simple that even an idiot could run the company because sooner or later. And I think you want to remind people of various political perspectives that we live in a polarized country. Somebody you may agree with tremendously or disagree with tremendously may be running the country at any moment in time. But when you think about what makes the United States a great country, you could cite things like the rule of law, but a lot of countries have probably a very tremendous constitution and court system and so on, but no economy. So they're not great countries. I think if you think about the United States, the economy in the United States is the engine that powers all of the things that we tend to value. And it is a very impressive engine. So while all of these things are going on in the political culture of our country, I'm not saying they don't have impacts on the economy. They do, but the creativity, the innovation, the enterprise that has been a hallmark of the U.S. economy, certainly for all of my life, and I think long before that, is the driver. And it's the thing that's easy to be distracted from looking at. But, even during the financial crisis of 2008 and 9, which in my opinion was the worst that I ever saw in my career, people were still buying things. Companies were focused on their business and responding to the challenges. And ultimately, the economy transitioned through it. And though it was an unpleasant period of time, it wasn't fatal.
Richard, at the beginning of the session today, Greg went through several of your credentials and that you've been doing this for a good long time. As you were going through that answer, I wondered, was there ever a time in your career where you just thought you had it completely figured out? You knew what the market was going to do next. You knew the direction in a really meaningful way.
Well, those tend to be the viewpoints of a younger person. There was probably a time early in my career where I did think, yes, I've got this figured out. I felt like I had gained the skills and the insights necessary to do the job well. But the one thing about this particular line of work is it has a way of humbling you pretty quickly, in that there are, over time, there are themes that are recurrent in the markets, in the economy, that you feel like you understand, but then you also, if you're paying attention, realize they begin to change. So there was, if you think about the focus that the country had in the 1980s, for instance, we had the great adversary of the Soviet Union, but then when the Soviet Union fell, there was the peace dividend, and the peace dividend was going to usher in a new period in time where we didn't have this ongoing conflict. More money could be redirected to more productive ends. And it was for a while, but that didn't last. And I think that's the kind of thing that tends to bring you back down to earth, is to realize that even good trends don't last forever.
I think that was a good question or a good answer to the question that was or maybe you could expound on that, which was, what was something that you learned the hard way in this business?
Probably early on, there are two notions that I think you see both at the academic level and at the functional level. One is that people make rational decisions, and the other is that they always act in their best interest. However, in my career, I could point to many, many, many times where people did not make rational decisions and certainly did not act in their best interest. So, David Hume was famous for saying that reason should be the slave of emotions. And you think about that and you think, well, that seems backward. But I think he was saying, look, reason can't tell you what to want. It can just really tell you how to get it. And so when you realize that there are periods in people's lives when they're more inclined to make bad decisions, counseling them through those periods of time is valuable. You often hear, as a matter of fact, chairman of the firm was just here last week.
Yeah.
Pointed out that in periods of turbulence like what we're experiencing right now, our role is of even greater significance. I think that's right. And why it's right is that in periods like this, people will tend to make suboptimal, you may phrase it, types of decisions, and just helping them return to the focus on their longer term goals, tending to wash out the material that's in the media every day and say, well, all right, but does that really change? Or another way, as I said earlier, will this be something we're even talking about in 5 years?
Well, yeah, and I was just going to add that, on that same line of thought, a lot of times people want to talk about, well, did this investment that we're talking about, did it beat an index that they track, or did it do well compared to some index? And what I tend to tell people is that our job is to prevent you not from not doing better than the index, but from making one single decision that takes you out of the game of even competing with that index.
Yeah, it's an interesting point because throughout my career, a lot has been written about investment performance relative to some standard, some benchmark, like an index. But that's really the wrong question, I think. The proper question is, how did something do relative to what you would have done yourself? So often there's the comparison of a client who's being advised to an index, as if the client would have chosen the index, stuck with it through all environments.
Never changed.
Yeah, never. And that people often forget, going back to some of the original work on indexing, is one of the presumptions is that once you bought it, you never sold it. Well, the real question is, what did unaided investing result in? Were good decisions made? So it's often saying, well, let's just talk about the behavior of someone being advised versus the index that isn't a corporeal thing. It's just, so, well, what are we comparing?
It never needs to spend money.
Right. Never. It doesn't make any decisions. It's really saying, what would you do with it? It's sort of like you've got a bunch of tools in your garage saying, well, is the chainsaw better than a handsaw? Well, it depends on what you're trying to do. Yeah. Some cases it may not be. And so I think that's always the issue that people, and again, they're often directed in this way by the media, saying you need to compare your investments to this thing over here. Well, no, you need to compare your behavior to what you would do while you're gaining some advice. And by the way, that could be from your attorney, from your accountant, from your doctor, from your advisor. If you ignore that advice, sometimes you may be right, but how often might you be right, and how will you make the determination that you're not? This is the discussion that I have with people all the time. How will you know if you're wrong? So if you want to do this, and I want to liquidate my entire portfolio because of something I read in the news, okay, but what will you look at to determine if you were wrong? And there's often nothing that's going to be the standard to say, well, if that particular event doesn't work out, then I will realize I was wrong, and that may be a very costly, bad decision. Most of the time, there is no framework of that nature.
Well, I think just final thing.
No, go ahead.
On that subject. I think if you look at, say, the severity of, say, advice, going to the doctor, and they say like, hey, you should exercise a little bit more, is a little bit different than you need open heart surgery today, or else you're going to die. And so I think about it in kind of like 2020 was really traumatic. When COVID came about, people just did not know what was going to happen. We had the economy kind of shuddering around us. People couldn't go to work. They couldn't go to church. They couldn't go to school. and people made really irrational decisions. The advice, say on those days, was a severity 10 compared to maybe a severity 1. Would it be best to finance a car versus lease it?
Yeah.
Those are
Yeah.
a lot. The severity of that advice is very different.
And I think just to touch on some of the things you said regarding, measuring what you did with an advisor, not against how you would have done if you were in this nameless, faceless index, always just abiding by the rules of the index, which is reinvesting all the dividends, never taking any money out of it. Another thing that our clients tend to do when they do want to make these, what we would regard as irrational decisions, liquidating their portfolio, moving it all to gold, that kind of thing, is they never really account for returns not earned due to their decision. They love to look at it and say, look at all this capital that I preserved by having gone to cash during this period. But what falls off the map are the opportunity costs. And those can often be far more prodigious than the capital preserved.
Well, I think an attribution error here is people will often judge the quality of a decision by a factor that really isn't the most important factor. For instance, let's say that you avoided a downturn, which I think clients are always a little surprised when you say, look, that's the easy part of the decision. For instance, you could simply set a stop. You could use a moving average, something like that, to say if whatever we're looking at breaks the 20-day or the 50-day moving average, you can whatever you want, you're out of it. Okay, that can often help you avoid a major part of the downturn, but that's the easy part of the decision. The difficult part of the decision is first of all, what do you do once you're in cash? And secondly, if you feel like you need to own risk-based assets, and I would argue most people do, to achieve their goals, when do you re-enter them? And that's where the mistake occurs. Because frequently the case throughout my career is that as the markets were turning and beginning to actually go back up, the news cycle was getting increasingly negative. And there were the invariable stories saying, well, don't be fooled by this small recovery.
Yeah, the dead cat bounce.
Yeah, it's going to go down, another 30, 40%. Always the case. And these can be very persuasive. The problem then is that now when the investment, whatever it is back above where you got out of it, really difficult for people to say, you know what, I have not made a good decision here, and I'm going to override my entire emotional system and just admit that and put my money back in the investment.
Yeah.
Yeah, it's like you kind of have to admit you're wrong to buy back in. At that point, you maybe make the decision to just be a bond investor.
Yeah. Yep. And people do that. I mean, you see that where people get used to the comfort of, and I think we can appreciate, it's not fun to log in and see that your stuff has varied in value, particularly on the downside by 5 or 10%. Like a couple of weeks ago, it might happen in an hour, and so people could grow. We appreciate that that brings us a certain degree of discomfort. And so you can have this notion where people have, I think Scott and I have coined the illusion of wealth, where you've got all these very safe assets and you think, wow, I've got all this money that's really safe. It's paying me a decent interest rate now, not recognizing that, well, this is going to work near term, but it is going to be fatal long term.
Well, and it's fatal in a way that's very difficult to detect day to day.
Uh-huh.
I mean, it's like a lot of pernicious types of conditions in that it's slowly grinding you up and you don't really perceive it day to day.
Mm-hmm.
But, there are mistakes people can make investing, taking too much risk, not taking the appropriate amounts of risk, or not having a high enough return stream from a given set of assets. Those are both mistakes you can make, although the more dramatic of the two that normally is most easily observed is taking too much risk, because there's a major event, the value portfolio declines dramatically over time, and you can see it. Whereas one of the things we see in our work that's very difficult for people externally to see is that you'll have two clients where one maybe has tinkered with their portfolio a lot, felt like they're avoiding risk, and has underperformed one of their peers, someone who pays no attention.
Ignorant.
Don't pay any attention at all, and they've outperformed them by miles. Now, and the thing is we tend to talk about percentages. Well, this one went up 8 and the other one went up 7 and so on. But you look at that difference over the course of a very long period of time, it is a huge amount of money. And I think that's one of the things that is often misleading to people is they believe, well, over a long period of time, 7.5 and 9 are pretty close. No,
Not at all.
not really.
I think one of the things you've said to me many times is over the course of your career, you've received countless calls from clients saying they wanted to really kind of get in there and construct their own portfolio of stocks they thought would do well. And you would often tell them bluntly, I already know which stocks you want to buy. I don't have to ask you. I know based on the news. And this is a phenomenon that we've grown quite used to, where you have exuberance and money is flowing into things as they're getting very highly valued, and it flows out of them at the exact wrong time.
Well, one of the things I think we have to just be aware of is that human beings are communal beings. I mean, I think if you look at human history, being embedded in a community was a very good decision. It helped you survive. So the instincts that are primordial are very difficult to override. People like to do what other people are doing. When Hannah was a very young kid, we were flying one time, and they called the flight saying, well, we're about to start boarding the flight. And even though you were going to board by group and so on, everybody's pretty much, except for me because I'm lazy, everybody stood up.
Universally.
And she said, why are they doing that? And I said, I honestly would guess they don't even know. They're just noticing that other people are doing it. And I think in investing, we need to be aware of the fact that there's comfort in feeling like you're doing what everybody else is doing. But this is a realm where that is often not very rewarding. So if you find, if everybody tends to be sort of panicked about something, that's probably a time where you want to ask yourself, should I be panicked? Do I think in my portfolio I'm taking too much risk? If you are, then it should be addressed. But if you're not, you probably don't want to make major changes at that point in time.
Yeah, that really ties into, it's interesting how sometimes we'll get what strikes me as a question that's just completely out of left field. Like, I don't know, something about something that happened in Southeast Africa that doesn't seem to really focus on, the business that we're working. And then I get the same question 10 or 12 or 15 times because, it's an idea that is pervasive enough or is interesting enough to kind of get some traction. And then everybody wants to know about said company in Angola or wherever it might be.
Well, it's something that I've observed throughout my career is our client base they are not normal people. What I would tell you, they are, I think, by pretty much every measure you want to use, well above average, better educated than most, more diligent than most, more disciplined than most. And consequently, if you observe what I would call an error that is common across that group of people, we've said this many times, we probably have more hard science PhDs than most advisors in our line of work. So when you find people with that degree of accomplishment making the same kinds of errors as someone maybe without that kind of background, you realize these aren't errors of cognition. They're emotional errors. And the emotional errors are often very hard to detect by the person who is making that kind of a mistake. But from an external viewpoint, you can point out that, well, everybody in my career, if people were going to call and ask with something in mind, like, you know what I think I better do right now is buy NVIDIA. You say, well, chances are good that you might not want to do that because it's a theme that everybody seems to have gotten on board with. I better get out of the market. I better, own some technology stocks. In the late 90s, this was one of the most common areas of conflict that I have with clients is they would want to buy a basket of companies, and I would say, well, do you know what any of these people do? Something internet. Okay, but like what? No idea. But it was the thing to do. And one of the things that was so easily predictable at that point in time is that would not serve them well over a short period of time. What we want to be aware of, I think, now is that I think artificial intelligence is going to be in a similar realm. It's a little different. We can talk about that if you're inclined to, but it's where people realize this is going to be significant. Technology industry, I think, has observed this in their own way many times. probably be short-term, overly enthusiastic, longer-term, maybe not as enthusiastic as they should be.
Right.
But in our work, you have to guard against that because a lot of damage can be done by taking on too much risk in the short run, even if in the long run it proves to be a pretty good idea.
Yeah, and I think that was the note that I made to myself there, because I've recognized this for myself personally, particularly when it comes to parenting, is much of my anxiety is caused by mismanaging my expectations. This might be true of a marriage, this could be true of a stock, and then also being overwrought about implications. It's saying, well, we got Liberation Day. What does that imply? Not just for the immediate pain we all experience, but maybe for the stock market as a whole. And what are our expectations, and where might people get this wrong when it comes to investing? Say you have the wrong set of expectations. You're not setting out to beat the S&P 500. And just because we had a difficult, say, bond market in 2022, that doesn't imply that the strategy isn't working.
Well, yeah, I think a basic question is, how long is the game? You will often have clients call after, say, the second inning. So I don't like the way this is looking. Greg might not remember this, but during the World Series,
I remember
when he was a little kid, he wanted to make a bet, and you had
$1.
Yes, you had Arizona.
I had the Diamondbacks. Yes.
So we were in the final game, and they were down something like 5 runs.
Yeah,
and he was so upset about it. I said, "Well, I'll tell you what. I will take them. I will take the Diamondbacks now. Game's not over." And
they were going against the Yankees.
Yeah,
I remember.
Yeah.
Well, at any rate, Diamondbacks rally and win. And Greg said he wasn't going to pay. But I think the point is that often it's easy to lose sight of the fact that how long is the game?
Mm-hmm.
An anecdote I tell people is, a friend of mine was the CEO of a publicly traded company, to remain nameless, and it was acquired some time ago. Because I had so much faith in him and his abilities, both as a person, a businessman, and so forth, I was a shareholder in the company, and I was a shareholder in the company for more than 20 years, and the stock did virtually nothing for more than 20 years. I mean, it would go up a few dollars, and it stayed between, say, 3 and 8 for decades. And then time goes by, the company evolves, he retires, new management comes in, they have different goals for the company, and ultimately sell it for something like $85 a share in a merger. So the question was, when was it a good investment? Well, certainly the last few months, it was terrific. But was it a bad investment? And every time I had a little bit of extra cash, I would add to it, because I just liked what they were doing.
There's this wonderful book, I think it was written in the 1940s, called How to Lie with Statistics. And one of the easiest ways, he says, is you can average things. And so this question that you've posed often to clients is, when was this a good investment? It's sort of been, this problem has been compounded by the radical move towards transparency and the availability of data in our industry, because people will look and say, well, this fund here has had a 12% annualized rate of return versus yours, or the one that you've recommended. And then you look at it and you say, well, you accrued a disproportionate share of those annualized returns in one kind of aberration year where one company did extremely well, and they've actually been amortizing that return over time. So your future results are not at all connected to what this annualized rate of return is.
Well, we have to keep in mind that transparency is something that gets a lot of discussion, but transparency doesn't convey meaning. So it's, as my friend Professor Keith Brown likes to say, that analysis is kind of like you're given a box full of puzzle pieces, and you've got to figure out, what do they mean? Where do they go? And I've said it's even further compounded by people putting fake puzzle pieces in your box from time to time. You go, well, that's not even the same puzzle. But that's, you can say, well, you've got all the pieces there. You've got everything you need, but that's not enough. You've got to figure out, where does this fit? And I think when we think about information and how to make information valuable, you have to take in a particular fact and ask yourself, or first of all, determine, is this even a fact? And where does it fit? Where does it fit for me? Where does it fit in the broader spectrum of decision-making in an industry, for instance? And the answer is, it may in fact be trivial. It may seem meaningful, but it's trivial. I remember when I first read Taleb's Fooled by Randomness, and It is, and you would find examples of where people are fooled by randomness all the time. This is something that happened. It's given tremendous significance. There's a lot of that in regulation, for instance. If you think about Sarbanes-Oxley, by the time we rolled around, that was early 2000. 2008, you might have asked yourself, well, shouldn't we kind of have prevented this with the last bit of treatment that we gave to these kinds of concerns? No, it didn't. It really didn't. And so we have to be aware of the fact that events are going to draw a lot of attention. There's a belief they're going to be recurrent. I remember after Hurricane Harvey here in Houston, people thought we would probably flood, every 6 months.
Yeah, every year or so.
Yeah, really hadn't done that in 100 years. But again, because that latency factor was so powerful, saying, well, I remember standing up to my armpits in water in my front yard. Definitely leaves an impression.
Yeah, I think one of my favorite quips about that is I love all of the various cognitive biases, but my favorite by far is the recency bias.
Yeah.
Richard, I was just going to say one last thing on the AI question.
Yeah, let's get into it.
Say impacts on our business, impacts on the world at large. I was listening to somebody else recently who was kind of talking about the internet as something that is maybe not it wasn't really a business that created the internet, as opposed to it became like a utility more than anything. At this point, do you feel like AI is an app on the internet, or do you think it's a completely different utility that is going to maybe have a whole nother 9 innings beyond the one that we're looking at?
I think we could define AI 2 ways. Artificial intelligence, we're already experiencing that in a lot of ways. Google Maps, as an example, is an example of artificial intelligence that now guides you to a destination pretty effectively most of the time. I know every time I've ignored it, I've regretted doing so. If we differentiate that from AGI, artificial general intelligence, which is, I think, when people like Kurzweil talk about the singularity and so on, I think that's a very different thing. That's really saying we're creating something that's going to achieve what we would probably call consciousness. It's going to be truly thinking, making decisions on its own. It will surpass us. I think the people who've done research in that realm believe it will surpass us by vast margins, where it will no longer need human intervention of any kind to find new things, make discoveries, and so on. So if we talk about AI and the way it'll impact industry, it's doing it now. We'll set AGI off in a different corner for the time being. So we'll see it, and we see it now. Chatbots are getting better, as an example. There's a whole lot of fundamental research that can be done in our industry that AI could be very good at doing, because it's extremely good at assembling facts, drawing comparisons, correlations between sets of data, and so on. So I think it is going to be quite significant. I think the notion that it will completely replace humans in all functions is maybe a little bit overdone at this point in time, until we achieve the bigger outcome, I've studied philosophy in college. So Alan Turing predicted back in the 1950s that we would reach a point in time where it would be very difficult to differentiate a computer from a human. Interestingly, now we could make that Turing test change its terms just a little bit to say, well, we would know we're dealing with an AI if it didn't make any mistakes.
Right.
If saying, wow, this person no way could know that much, it must be a machine. And I think that's the evolving reality of what artificial intelligence is going to mean, is that it's the vast amount of factual data that can be delivered to you extremely quickly. And anybody who's used it, I think, has had that experience, to ask it to summarize a book that you're thinking about reading, for instance, and how well it does that. So I think those capabilities are going to expand very, very rapidly. Autonomous AI, where it is deciding itself, I would, again, set that aside to be something that is out in the future. But that, I think, is what, when you hear the more dramatic claims for AI, that's what they're talking about. And I think that's a little bit further out than maybe what is of interest to us at the moment.
Yeah, I mean, Scott and I talked about how, and this gets back to expectations and implications, where people tend to jump from, we all have jobs that we have come to enjoy, particularly white-collar workers in our industry, lawyers, accountants, engineers, physicians even, maybe not surgeons, but even in that case, you have robots. And I maybe think that people are underweighting the period of time that will be represented by augmented intelligence.
Oh, sure.
Or it's saying there's probably a really long runway where our jobs are going to be made not obsolete, but more efficient by augmentations to our intelligence with things like AI.
Without a doubt. One of the things I think a lot about just in day-to-day living is this notion that I call friction. How much friction is involved in doing something? You know, if someone like Kiera moves to Houston, you say, well, I understand that Houston has all of these wonderful things. They've got professional sports and a symphony and all these kinds of things. You say, yeah, but man, is it a hassle to get there. I mean, you know, the friction of just driving down to the rodeo, for instance, more than I would tolerate. I mean, just more trouble than it's worth. If you think about some of the things that AI can do in the short run, I think just removing friction in your life, these are things that are required, but they really are of no value whatsoever. You know, that if you could get rid of them, just completely have it. For instance, let's say your perception of driving to the rodeo. If the car is driving itself and you don't have to drive it, you don't have to make any decisions, and nobody else is making any decisions, because as I always like to point out, I don't mind driving. I just don't like drivers. You know,
Right.
So, you know, so if all of the machines were behaving in a uniform manner, nobody tried to cut in ahead of 50 cars on the off-ramp or something like that, the experience would be very different. So I think that's one of the big wins potentially of AI, is just cutting down the amount of really useless time spent to achieve some objective.
I mean, it goes back to almost one of the first things that we talked about is working to spin a wheel or the Sisyphus rolling the
Right.
rock up the hill. If AI helps us to not be doing that as often and to
Exactly.
actually, you know, keep the ball or keep the rock at the top of the mountain once it's there,
Well,
that's pretty valuable.
Think about the impact on things like research. When I got the master's in financial planning, it was a research-based program at the time. I think it's evolved a little bit in the years since, but just going out and getting the source material was really cumbersome. It took more time often than it should have to maybe get a small citation that you wanted to use in your paper. Now you can do that almost instantaneously. And you can also search for things very, very similar to that. So I think that's an example of removing the friction to an outcome that is tremendously valuable in my mind.
Stephen Kotler and Peter Diamandis, they've written on this extensively, but it occurred to me as I was driving to work the other day, actually, because a person used a turn lane to skip big line in traffic
Sure.
and then cut over, and the cars, for whatever reason, yielded to this person, obviously kind of breaking a social rule, which is
In Houston, this
Oh, yeah.
happened?
Well, can you imagine?
Yeah.
Yeah. I mean, breaking a social rule, and you see this kind of stuff all the time. And Rory Sutherland has talked about this, where he says if you put a cone with a balloon on it,
Right.
then the self-driving cars are going to go, in his very British term, doolally, which I think is hilarious, but also prescient, because it occurred to me that, say you do have a line of cars, and understanding that a Waymo taxi can be hacked, so to speak, where if I'm making an unprotected left and I see it's a Waymo taxi coming my way, I can just turn out in front of it because it's going to stop, or I can cut this Waymo taxi off because it's going to avoid incident. How painful is that transition, where you have no autonomous vehicles and now we're at a semi-autonomous state, but to get from semi-autonomous to full without legislative, essentially, demand, how do you get there without people just hacking these cars?
Well, I think we're talking about a much bigger principle here, and that is we have rules of behavior. They can be laws, they can be etiquette to make life flow better.
Mm-hmm.
So these can be, don't cut in line, don't go straight from the turn lane, things like that. However, people realize very quickly that gaming the system conveys an advantage to them at the expense of other people,
Yeah.
for which they often don't pay any penalty.
No penalty.
Now, there are occasions when you can make these people pay the penalty. For instance, you've seen cases maybe where just by bad luck, there was a police officer there. And by the way, and I think that penalty should be fairly severe because it's going to cause fewer people to game the system. What's going to happen, I think, is if we think about AI, this is a far more comprehensive utility, I think, than anything we've seen in the past. So understanding ways to game the system, it will rapidly incorporate into its perception, if perception is the right word, into its way of accommodating the ultimate goal. If you read guys like Eliezer Yudkowsky, who talks about what OpenAI Chat 4 is able to do when given a task, shocking.
Yeah.
I mean, really shocking. At first of all, you would say how intelligently it went about it. But I think things like the cone and the balloon, rapidly the AI will simply calls out. So, let's say, for instance, somebody came out, fingerprinted it, and went directly to this person's house and arrested them.
Right.
So that won't last long.
Yeah.
And so it will, I think the ability to cut down, and by the way, I think that to a large extent, the AI offers the opportunity to remove cheaters from systems, to recognize them very quickly, and to fairly dispassionately say, I'm sorry, but you're cheating, and we're not going to allow you to do that. So you will have to go back to the end of the line or whatever it is that we're talking about, where no individual has to hear a story about, well, but I've got to get, my ice cream was melting.
Ask yourself what winning looks like.
A friend of mine likes to say, once you have the ball in the end zone, never take it out. To me, having some clear idea of when will I know that it's time to stop, that the matter is closed, the game is over, turn off the scoreboard. Make one decision that accounts for 1,000 is develop some processes where you are sure that you're not overlooking something that you need to do. So I often tell clients, view the various elements of your portfolio as workers who are working for you.
Thank you for listening to another episode of the Personal Finance Project. This show would not exist without the help of our brilliant creative director, Kira Minifield. Kira, thank you for everything you do to keep this show running. On to the disclosures. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider carefully information contained in the prospectus or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value, NAV. Baird does not issue or underwrite mortgages and does not service mortgage lending services. Any references to mortgages in the financial services offerings are purely intended to convey an engagement in this holistic planning process, with this as one piece of the larger picture, which may or may not apply to all clients. This broadcast may not be reproduced without express permission of Robert W. Baird & Co., Incorporated.